Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, I'm going to provide a market update with returns to the end of December. Happy New Year, by the way. I also provide this information on a blog post, which you can reference, and I'll also show those that are watching the video here. We'll pull up the graphs as we go along on the screen. As a brief legal disclaimer, my discussions here should not be construed as financial or investment advice, and each person's situation is unique. All right, let's go. So, starting with our usual graph, you'll see the graph on the screen. I'm pulling up a table of the major asset classes. I'm just looking down here as we go through as well. So, looking at the month of December, pretty much it was a flat month. Unlike last few months, they always seem to be moving pretty nicely. One exception, I guess, both international equity markets were positive 3% for the month, and then on the negative side, you had long bonds, REITs, and Bitcoin were down for the month. But otherwise, the rest were major asset class returns were flat. So if you do look over at the year-to-date returns, however, there you're going to see pretty impressive returns. So as I look down the column here, the only negative for the year is going to be Bitcoin, that was down about 6.5%. Again, very volatile asset class. Otherwise, the rest were showing pretty very nice returns. I guess the two other besides Bitcoin that weren't as strong, although again positive, REITs were only up about 3.7 year to date, and the international bonds, I used currency hedge, and so this is the currency hedged international bonds. Those were up only 2.8%. But otherwise, the rest were showing some pretty nice returns on a year to date basis. And then if you look over at the bond section of that table, I'll talk about the bond curve and the curve shapes later on in the podcast here. But on the table, the total returns, you'll see that the 3-month, shorter duration, I should say, bonds had a positive return for the month. 10-year was only down slightly, but down. And then the 30-year bond, or the long bonds, 20-year plus we show here, they were down 2.5%. And so what that means is the curve steepening, I guess, for you from the visual, the short end rates were either flat or went down a bit, and the long end rates went flat or up. And so the difference between those two moved. Short rates went down, long rates went up. It's called a steepening. And so the longer the duration bonds, when rates go up, bond prices go down. So that's why you see the negative return. And then again, for the corporates and the muni returns, those are again kind of flat up a little bit for the month of December. But again, if you look at those year-to-date returns, investment grade corporates up 7.8%, high yield up 8.6%. In my opinion, those are more like equity-like returns with a hell of a lot less volatility. So equity-like for those normal markets, it's been quite strange the last 5-10 years. Everyone thinks the new normal is 12-15% returns with equity. That is not normal, just by the way. So anyway, bond returns equity-like, in my opinion, of late. So that's a quick summary of the table. Now shifting over to the next graph on the screen, I'm going to show you my returns of the major asset classes. I just show 4 major asset class ETFs here, just for a bit more cleanliness, if you will. So I guess for the third month in a row, the last couple of months I've been mentioning there's this mid-month blip, and then the market recovers by month end. It happened again in December, so a little tougher to see on the graph because it's now a full 12 months worth of year-to-date returns. But if you squint your eyes, you can see the purple and the green lines there. It does dip down mid-month, and then again it turned around. I'll talk about the very last week of the month in a second, but it turned around. Two drivers. One, on December 18th was the CPI release for November. That's a bit later. Again, recall the government was shut down for a while. So CPI on December 18th, and then the jobs report on December 19th. And then, so, you go into the end of the year strong, not much liquidity. So there's not much buyers or sellers out in the market, but most people are kind of in a giddy mood. And so any activity is on the buying side. So usually you see the markets end strong into the end of the year, called the Santa Claus rally. And it was doing that, again, in my opinion, more because of those reports I just mentioned. But the last few days of the year, and especially even the last day. I was here on New Year's Eve. Market definitely closed weak, and so you'll see on the graph it did pull back there a bit, but that's just the way the year ended. So that is the usual summary of the year-to-date return ETFs. And so now up on the screen, you're going to see. I'm going to show two graphs in a second here. The first one, both of them are going to talk about the composition of the S&P 500. So the first graph shows, and this is both of these graphs are coming from the JP Morgan Guide to the Markets. And so they put out a report every month. If you're willing to exchange your email, you can get the details for free other than your email. If you don't want to do that, you got to wait till quarter end, and it might be a bit delayed. So these graphs are from that report. Very powerful report. Recommend taking a look at it. The first graph here is showing the composition of the S&P 500 and what portion of the market cap is coming from the top 10 companies. And you can see, it goes back for 30 years, right? Yeah, 30 years. It's pretty damn high, 40.7%. So the top 10 companies are making up close to 41% on a market cap basis. The last time it was that high was like 25% back in right before the dot-com blow up. Again, I'm not implying that this high concentration is implying that, but you definitely want to be very aware that when you're buying the S&P 500, 41% of what you're buying is concentrated in 10 names. You'll see that nice green line that shows the earnings, and so they're pulling their weight. They definitely are generating a lot of earnings, but it's a very high concentrated market. And if you look over to the left of this graph, you can see the PE ratio. So the top 10%, the green line up here, 28.1% is the forward. These are forward PE ratios of those top 10 companies. And then the rest, the remaining, the S&P 490 in this example, down at 19.2, which is still pretty high, but there's a big dispersion in those two. So graph one is showing you, pretty concentrated market. Top 10 names make up 41% of the S&P. Now, the next graph we're showing is going to be the Magnificent Seven. So that was a big topic, I guess, starting in 2022 is when it started heating up, and then 23. So as a brief reminder, the Magnificent Seven stocks, I got them written down here. Those are made up of Apple, Microsoft, Amazon, Google, it's now called Alphabet, I guess, Meta, the old Facebook, NVIDIA, and Tesla. So those seven stocks, those are commonly referred to as the Magnificent Seven or the Mag 7. So the usual story over the last few years are, I just mentioned the top 10. It's like, well, it's the Mag 7 that's doing it. Focus on those names. They're still important, so don't get me wrong, but they're not as important or as much of a driver as they had been. Still very strong, don't get me wrong. So the left-hand side, it's kind of small on that table there, but if you see the percentage of returns being driven by the Mag 7, in 2023, 63% of the S&P return was coming from the Magnificent Seven. So 24% S&P return, 76% was the return for the Mag 7. So big percentage. In 2025, you can say it's now down only. It's still quite high, but down to 46%. So still present, but not as overwhelming. And then on the right-hand side of this graph, we're showing, you can see the Magnificent Seven names. In 2023, they actually have the names next to the columns. But looking to the right there, for 2025, only two of those companies' returns were higher than what the S&P return was. Google and NVIDIA. Those were the two stocks that continue to pop hard, but the rest, again, solid, but not as dominant. So enough about that. And so that is a quick summary of the equity side with the graphs. And so now we're going to switch over to our usual bond graph. There I show the last 5 years. And then this month I added the 2-10s curve, which I'll talk about at the bottom of this graph. And I guess the few things to note on here are you got to kind of squint, but I'm going to separate it into the short end of the curve and the long end of the curve before I talk about the curve steepening. And that is I'm just referencing my notes here. So the 3-month and the 2-year rate, if you take a look at those, you can see those rates on the right-hand side of the screen there. Those rates are continuing to kind of drift a bit lower. And so the Fed is active. They're still cutting rates. We'll talk about them in a second. But you've got the 2-year at 3.47 on this graph. This is coming from YCharts at year end. And then the 3-month T-bill, it's a little funky the way they calculate it, but they show it at 3.57. It's actually a touch higher than that, what you see in the market, but 3.7, 3.57 per YCharts at year end. But everything else, and so the 10-year, 30-year, the triple B corporate index bond, and then the magenta line, got to say magenta, that's our 10-year real yield, TIPS real yield there. Those are all, again, not exploding higher, but I'd say they're flat to slightly drifting up. And so, there again, the Fed controls the short end of the curve. The longer end is flat to actually moving up a bit higher. So you just want to be aware of the bond market and what's going on with each of them. I'm talking about separating the short end and the long end. And so the graph at the bottom, the purple line there, is I call it the 2s-10s curve, but the way it's calculated is the 10-year treasury rate minus the 2-year treasury rate. And that was actually negative, back in 23 when the interest rates were raising, when the Fed was raising short-term rates. That got us, negative, close to negative one, just over 1%. It was 1.1 to be exact. But now it's at a positive 0.71. So continues to slowly drift higher. For the year, it's steepened by, I think it was 38 basis points. The last thing to point out, the credit curve. And so you look at the brown line, that's the triple B credit curve. It's going to be difficult to see on the graph on the screens, but I did the calculations for you. So for the year, so the triple B yield minus the 10-year treasury rate, that's the blue line there. So that difference is called the credit spread. So that tightened about 10 basis points for the month, but also on a year-to-date basis. And so, again, spreads continue to remain tight. It's something to watch going into the 2026 year as well. So that is the summary of the bond market. So now we're going to shift over to two special topics of the month. And so the two topics are going to be the Federal Reserve, and then I'm going to talk about just some updated 2026 numbers for you. So the Federal Reserve, they had their last meeting that concluded on December the 10th. They cut rates by 25 basis points as the market expected. So that's bringing the Fed funds range, or keeping that damn range, 3.5 to 3.75 is where we're at. For the year, that's 0.75 lower, 75 basis points lower. Those that had a home equity line that still have it, you're happier by 75 basis points relative to the beginning of the year. And so that's what they did. And then they also, the Fed announced they're going to buy back about 40 billion. They're usually pretty exact about that. 40 billion of T-bills, but for the next few months. And so just to get them through year end, they felt that their reserves were adequate, as they mentioned it. So that was the meeting. They cut rates. The T-bill announcement was a little bit of a surprise, but not a major thing. And then, of course, the press conference, which I'll mention a few highlights, but also the summary of economic projections. So we're showing a graph on the screen now of that, the table, the quick summary of the summary of economic projections. And a few things to note there, I highlighted it for you, is one, notice a large jump. And so I guess a brief summary, this summarizes, I think it's 19 Fed officials, the 12 presidents and 7 governors, their views on those 4 key things: GDP, unemployment rate, and then PCE, which is the Fed's version of inflation, personal consumption expenditure index, both headline and core. So I highlighted 3. One, the change in real GDP, 2.3% for 2026, which is quite a jump with what they were expecting here in 2025. But Powell, in the press conference afterward, noted that part of that was the government was shut down for a big chunk of October or November, I guess, whatever it was. About 0.2%, he said, of that was just a give back during the government shutdown. But the other interesting thing to note is the PCE numbers. And so 2.4 and 2.5, again, when they have the years, those are year-end expectations. And they're expecting 2.5%-ish for PCE. The reason I'm bringing that up is the Fed is expecting to hit 2% inflation, but they're still a ways away from it, and they're in cutting mode. And so earlier I was talking about, does the Fed have enough room to cut rates with inflation where it's at? Again, at the press conference, Powell mentioned 2 things. One, in his opinion, and I guess the Fed's opinion, they think that actual jobs numbers being reported are maybe about 60,000 a month lower. And so the jobs report is weaker than maybe the headline is indicating. So they need to keep cutting. And on the inflation side, he mentioned with the tariffs, they do think it's temporary and they're watching it, but they don't expect any related tariff inflation that does come through to be sticking. And so anyway, those were interesting. And so that's why they give them room, in their opinion, to make the cut that they did. Powell also mentioned in the press conference, though, that they don't, well, in his opinion, that they felt that the Fed funds rate was now at neutral rate, maybe at the high end of neutral, but he wanted to give himself some room to likely not cut rates in January until they get more data. And so that's what the market is expecting as well. So actually, one more quick thing on the SEP. I'm looking down at the bottom, the Fed funds rate. So you might have heard this as a dot plot if you follow the Fed minutes and the news right on those days. So the Fed, 19 summary of the 19 votes, if you will, we're at 3.6, which means at 3.5 to 3.75. So by the end of next year, they only expect one more rate cut. And if you go out 2 more years, 2027, cumulatively, maybe one more in 2027. So that's not very much. But if you look to the far right, it shows the full range of views. So again, let's look at 2026, 3.4. So one rate cut is the collective view of the 19. But if you look at the range, 2.1 is that's the one I'm drawing a blank on his name. Myron, it's probably his 2.1 by the end of 26 is what he would like to see. And then 3.9, so actually a rate increase by at least one official. Maybe it's Goolsbee. He was one of those that dissented. He did not want a rate cut this last meeting. So anyway, interesting, a lot of different views on the Fed right now and a dispersion in views. And so anyway, I beat that dead horse long enough. Let's move on and then the market pricing. So this is what the Fed told us. You can also see what the market is expecting by checking out the CME FedWatch tool. I don't have a graph to show you on that, but if you go to it, CME website, they expect the market, the Fed funds futures market, definitely at the January meeting, not expecting a rate cut. There's about an 88% chance, I just looked this morning, that we're going to keep rates where we're at. However, if you type in or punch in the end of 2026 Fed meeting, December, whatever it is, there it's showing there's at least 73% chance, this is from a couple of days ago, that there will be at least 2 cuts and maybe even more. So again, as of January 6th, that was showing 73% chance. This is what the Fed is guiding, but look what the market is saying as well. So anyway, enough of that. We'll take that graph away. No more graphs, so you're stuck looking at me now as we talk about the last special topic, and that is just an update on the 2026 IRA contribution limits, tax changes, and there's actually even a Secure Act 2.0 that's from a few years ago, but there's one more lingering thing that's going into effect. The first thing is new contribution limits. And so it's on my blog post, and so I won't rattle through all of them. But in general, what you can contribute to a 401k went up by 1,000 this year, so 24,500. If you're an old fart like me, 50 plus, that's still young, don't get me wrong. Your catch-up provision went up by 500 to 8,000 a year. And then there's that special, this was new last year, so it's still in effect. If you're between ages of 60 and 63 by 12/31/26, you can drop that 8,000 and you get 11,250. That was the same as last year. Traditional IRAs, increase them with inflation each year, but they only do it, rounding it to the next 500 or the catch up $100. So that did happen. IRA contributions is 7,500 this year instead of 7,000. And the IRA catch up for age 50 over, that's now 1,100. 7,500 if you're below 50, 8,600 if you're 50 or over. There is no super catch up for them. Love them. Check them out if you apply. 4,400, 8,750 if you're a family. And then if you're over age 55, not 50, but 55 for HSAs, you get that same $1,000 catch up. No increase there. The other thing, I mentioned the Secure Act 2.0. That was back in, I'm going to say like 2020 and then again in 2022. There was a provision that was supposed to go into effect in 24. They pushed it back. They pushed it back again, but it's happening in 2026. And that is, I just mentioned the age 50 plus catch-up contribution. So either 8,000 if you're 50 or over, or 11,250 in that special band. If your wages, so this is not income tax up, but wages from the same employer in 2025 was 150,000 or higher, you have to put your catch-up contributions into a Roth 401k. Not to worry, your plan sponsor will take care of that. They should take care of it, I should say. So if you're in that camp and you're putting in your contributions, they're going to force you to put that into the Roth. But I meant emphasize the same employer of 25. So let's say, for example, you switch jobs and you now are at a new employer. It's like, well, I made more than 150 last year, but if you switch jobs, your current employer, did you have 150 from them last year? The answer is no. You're immune for one more year, assuming that you stay at the company. So anyway, a little nuance there, just to be aware of it. And then finally, tax law OBA. So I have a blog post, and actually I have a blog post. Go to my website. We show some links to the Secure Act and stuff, but also have a link to my OBA summary. So the One Big Beautiful Bill Act back from my July 2025 blog post. Many of those, or some of those provisions, I should say, were in effect in 2025. So just as a heads up, you might want to consider filing your taxes early this year, because a lot of people might be getting a refund given some extra deductions they got. No guarantees, but just check it out. However, some provisions went into effect in 2026. And so some of those provisions on my website I list. Charitable, if you don't itemize, you can deduct up to 1,000 single, 2,000 married filing jointly. Normally you just couldn't. It was wasted, if you will. If you do itemize, that's on a negative side. You're going to lose the first 0.5% of your modified adjusted gross income on deduction. AMT, read about it. It gets complicated, but they made some changes there. Federal estate tax, if you're fortunate enough to be above that, it went from $13.99 million per person, you can share it with a spouse, up to 15. So if you are happily married, 30 million is the federal exemption that you can appreciate this in 2026. Also be aware, though, there is some states have a separate state estate tax hit. Here in the great state of Illinois, we have a 4 million, and it's not portable. I think Massachusetts has one. Other states have none. So be aware there's also state estate tax issues to be aware. Trump accounts, and so if you had a child that was born between 1/1/25 through 12/31/28, they're going to work out the details of how to open them up and get them opened up in 26 here. That's going to be $1,000 coming from the government, and then you can contribute more if you want, but I got a blog post on it in the past. There's other choices you can go as well. So make sure that you look at other choices before you add to these, in my opinion. Farmland sales. And so this might have even been in effect last year. I'm not sure, but my initial reading of it was it started this year, but maybe it was last year. If you follow certain rules and you're selling farmland, which has been going up a lot over the years, large capital gains perhaps, you can stretch that out. Paying the capital gains, you can stretch out over 4 years, provided that you meet some rules. And so you have to been in a farming operation the last 10, expected for the next 10. Check the rules, but it's worth checking out if you're selling farmland and want to soften the blow of the capital gains. So looking at my clock here, I've been going for 25 minutes or so I better wrap it up. So that is a wrap on the market here. So check out the graphs. Thanks again for joining me here in 2026. Happy New Year, all. I like to say that through the end of January for new people I see. The sun sets a bit later these days, so that's a good thing. But we still have the same 24 hours a day to make sure we enjoy and account for. So let's bring it on. All right, that's a wrap on today's topic. Thanks a lot. Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.